Credit markets have been a key source of growth for private equity firms in recent years. Private equity firms use credit to finance their acquisitions of companies, either by issuing debt in the form of leveraged loans or bonds, or by borrowing from private lenders such as direct lending funds. According to McKinsey, private equity firms raised a record $2.4 trillion in deal volume in 2021, up 29%. From a large part of this activity was driven by favorable credit market conditions, such as low interest rates, high liquidity, and strong investor demand for yield. Low interest rates made debt cheaper and increased the returns on equity for private equity firms. High liquidity meant that there was ample supply of capital from banks, institutional investors, and private lenders to fund deals. Strong investor demand for yield meant that private equity firms could issue debt at attractive terms and prices, and also tap into new sources of financing such as collateralized loan obligations, CLOs, and special purpose acquisition companies, SPACs. However, credit markets also pose some challenges and risks for private equity firms. For one thing, the competition for deals increased as more private equity firms entered the market and sought to deploy their record levels of dry powder, unspent capital. This drove up the valuations of target companies and reduced the margins for private equity firms. For another thing, the quality and covenants, restrictions, of the debt issued by private equity firms declined as investors accepted lower standards in exchange for higher yields. This increased the leverage and default risk of the portfolio companies owned by private equity firms. In 2022, credit markets became more volatile and uncertain as central banks raised interest rates to combat inflation and public market valuations dropped. This had a negative impact on private equity deal activity, which decreased by 26% to $2.4 trillion, and banks became more cautious and selective in lending to private equity firms, while investors became more risk-averse and demanded higher premiums for holding debt. Private equity firms had to adjust their strategies and expectations in response to the changing credit market environment. One way that private equity firms adapted was by turning to private credit and direct lenders as alternative sources of financing. Private credit is a term that refers to loans or debt securities that are not traded on public markets, but rather originated and held by private lenders such as hedge funds, asset managers, or specialty finance companies. Direct lending is a subset of private credit that involves lending directly to borrowers without intermediaries such as banks or brokers. Private credit and direct lending have grown rapidly in recent years, reaching $1.2 trillion in assets under management in September. Private credit and direct lenders offer some advantages for private equity firms over traditional lenders such as banks. For example, they can provide more flexible and customized terms, faster execution, and lower fees. They can also lend to companies that are less attractive or accessible to banks, such as smaller or riskier businesses, or businesses in niche sectors or geographies. They can also provide more creative solutions such as unitranche loans, a combination of senior and junior debt, mezzanine debt, a hybrid of debt and equity, or preferred equity, a senior form of equity. However, private credit and direct lenders also have some drawbacks for private equity firms. For one thing, they charge higher interest rates than banks, reflecting the higher risk and lower liquidity of their loans. For another thing, they may impose stricter covenants or collateral requirements than banks, limiting the operational flexibility of the borrowers. They may also have more influence or control over the borrowers than banks, especially if they hold equity stakes or board seats. In summary, credit markets have been favorable for private equity firms in recent years, with low interest rates, high liquidity, and strong investor demand. However, credit markets also pose some challenges and risks for private equity firms, such as increased competition, lower quality debt, and higher volatility. In response to these changes, private equity firms have turned to private credit and direct lenders as alternative sources of financing that offer more flexibility and availability than traditional lenders.